Okay, let's dive right into the wild, high-yield world of mortgage real estate investment trusts. Specifically, we are peeling back the layers on Orchid Island Capital and their absolutely eye-popping numbers. If you're an investor who chases income-generating stocks, I guarantee they've crossed your radar. So in this explainer, we're going to unpack exactly how they operate, how they magically generate those massive returns, and of course, the risks hiding just beneath the surface.
To really wrap our heads around this complex financial engine, here is our roadmap. We'll start with that massive 17% yield. Then we'll look at the macro shock and market turn, break down their Q1 earnings, peek inside the actual mortgage portfolio, dive into hedging and leverage, and finish up with the ultimate dividend debate.
All right, Section 1, the 17% yield, and the numbers catching everyone's attention right now.
Heading into the first quarter of 2026, Orchid Island Capital boasted a massive 17.02% dividend yield. Now, when you see a number like that, it immediately demands the question, how is that even possible? I mean, in a market where a 4 or 5% yield is usually considered pretty solid, hitting 17% requires a very specific and intense set of financial circumstances.
Well, take a look at their trailing net margin. Over the last 12 months leading up to the end of 2025, Orchid's net margin sat at an incredible 88.6%. They reported over $159 million in net income on roughly $179 million in revenue. That gives you the impression of a highly efficient, almost unstoppable profit machine. And this comparison right here brilliantly illustrates the bull case. Despite those massive margins and that double-digit yield, the stock actually trades at a heavy discount. A trailing price-to-earnings ratio of 8.7 compares incredibly favorably to the broader U.S. market, which is sitting way up around 19.5. To a value investor, this looks like an absolute steal. But a discount this steep naturally brings us to the risks lurking beneath the surface. The market is clearly pricing in some danger. Which brings us to part 2, macro shock and market turn. Or, what happens when geopolitics totally disrupts your balance sheet? Let's track how this actually played out chronologically. January started off incredibly strong. On January 8th, government-sponsored enterprises announced plans to buy $200 billion of agency residential mortgage-backed securities. This was meant to drive mortgage rates down, and honestly, it worked beautifully for Orchid at first. But then, on February 28th, a sudden geopolitical conflict erupted in the Middle East, and almost overnight, the entire trajectory of the quarter completely reversed. As their CEO, Robert Cauley, explicitly noted in their earnings release, this exogenous shock instantly altered the environment. When war broke out, interest rates spiked, risk markets sold off, and implied volatility skyrocketed. Now, for a company that is heavily invested in mortgage bonds, widening mortgage spreads combined with high volatility, that's a toxic combination. It set up a brutally challenging close to the quarter. Let's move to part 3, breaking down Q1 earnings. It's really a tale of two ledgers. Okay, so the most important takeaway is right here. Their core engine, it actually worked perfectly. It produced a very healthy $57.1 million in net interest income. But the market volatility we just talked about caused massive realized and unrealized losses on the value of their actual assets to the tune of $69.6 million. So when you net the whole thing out, a profitable operating quarter suddenly became a $20 million net loss. You can literally see this play out on their unaudited statements of comprehensive income. Look at how fast those massive losses on RMBS and derivative contracts just completely overwhelm the positive net interest income. It is a harsh reminder that for a mortgage REIT, the interest you collect is only half the story. The underlying value of the assets you're holding fluctuates wildly with the market. Part 4, the mortgage portfolio. Let's look inside those agency RMBS assets. So their $11.3 billion portfolio is basically split right down the middle. 52% Fannie Mae, 48% Freddie Mac. These are agency residential mortgage-backed securities. Now that word, agency, that's the key. It means these mortgages are backed by the U.S. government. So if a homeowner defaults on their mortgage, Orchid Island Capital is protected. They have virtually zero credit risk. But they are incredibly exposed to interest rate swings. And that brings us to this absolutely crucial concept, the constant prepayment rate, or CPR. When interest rates dipped slightly in early February, their CPR spiked to 14.7%. This is super dangerous for Orchid. Think about it. When homeowners refinance or pay off their mortgages early, Orchid gets their principal back, sure, but they lose out on all that future interest they were banking on. Plus, they then have to reinvest that cash at potentially lower, much less favorable rates. Which leads perfectly into part 5, hedging, and leverage, the financial engineering required to make this work. The sheer dramatic scale of their operations becomes really obvious when you look at how they're funded. They use just $1.4 billion in actual stockholders' equity to borrow a staggering $10.9 billion through short-term loans called repurchase agreements. Basically, they take their safe government mortgages, pledge them as collateral to big banks, borrow a ton of cash, and then go buy more mortgages. That setup creates an adjusted leverage ratio of 7.8 to 1. This leverage is literally the magic behind the 17% yield, but man, it is a double-edged sword. It magnifies their income during the good times, absolutely, but it aggressively magnifies their asset losses when interest rate volatility strikes. Now, to their credit, they do try to manage this risk by spreading their borrowing out across 28 different lenders and maintaining a pretty strong liquidity cushion of $759 million. But to truly defend that massive, highly leveraged position, they rely on a really complex web of derivatives. What we're looking at here are their short positions on Treasury and SOFR futures contracts. Simply put, if interest rates go up, the value of their mortgage portfolio is going down. But these short positions will actually gain value, offsetting some of the pain. It's an intense game of active financial engineering happening day in and day out. Finally, part 6, the dividend debate. Bulls versus bears. It basically all boils down to this stark contrast. The bulls look at Orchid and they see massive trailing margins, a core engine producing strong positive net interest, and wide mortgage spreads that are meant to generate huge cash flow. The bears, on the other hand, point to a book value that dropped by 46 cents per share in Q1 alone. They highlight the extreme danger of a 7.8 times leverage ratio in a world that is so prone to sudden geopolitical shocks. So, I'm going to leave you with this to chew on. In a fundamentally unpredictable world where a single news headline can invert interest rates in an absolute instant, is a 17% yield a lasting, genuine opportunity, or is it just a high-leverage trap waiting to spring? That's the ultimate question you have to answer for yourself. Thanks so much for joining me for this explainer. I'll catch you in the next one.